All right, if you're a homeowner, you are probably always looking for ways to save a little cash on your mortgage, right? Well, today we're going to dive into one of the best ways to do exactly that. We're talking about getting rid of this pesky fee that you might not even know you have the power to just completely wipe out. Seriously, go grab your latest mortgage statement. Take a look. Do you see a charge on there for something called PMI? It probably feels like just another one of those mysterious fees, right? But what if I told you you have the power to make it vanish? Poof, gone. Yeah, that little charge is called private mortgage insurance, or PMI for short. And you know what? For millions of homeowners, it's a huge extra cost every single month. So let's break down exactly what this thing is. Okay, so get this. This is the crucial part. You pay for PMI, but it doesn't protect you at all. Nope. It's actually insurance for your lender, just in case you default on your loan. It's basically the price you pay for putting down less than that classic 20% when you first bought your house. But here's the good news, and it's a big one. It is not meant to be permanent. So the big question is, how do you fight back against this fee? Well, you actually have a powerful ally you probably don't even know about. It's a federal law called the Homeowners Protection Act, or HPA. Think of it as your secret weapon in this whole game. This law, it's been around since 1998, and it was designed for literally one reason: to give you, the homeowner, the clear-cut right to cancel your PMI once you've built up enough equity in your home. It's a law that's all about putting the power right back where it belongs, in your hands. And hey, here's a really easy way to remember what it's all about. Just think, HPA helps protect against PMI. How great is that? It's a simple little memory trick that just perfectly captures the whole point of the law. Okay, so this law, the HPA, it gives you count them, three different ways to get rid of PMI for good. And really, understanding these three paths is the absolute key to knowing when and how you can finally start saving that money. And to make it even easier, we can boil this whole thing down to one simple little framework. Just remember this, the 70-80 final rule. So let's dig in and see what each of those numbers means for your bank account. All right, the first two parts of this rule are all about your loan-to-value ratio, or LTV. Now, don't let the terms scare you. It's super simple. It's just the amount you still owe on your mortgage compared to what your home was originally worth. So, once that ratio is scheduled to hit 80%, you now have the right to call up your lender and ask them to cancel your PMI. But, and this is great, if you forget, the law has a built-in safety net, because when your LTV is scheduled to hit 78%, your lender must cancel it. No questions asked. It's automatic. So think of it this way. You can be proactive at 80, but it's a sure thing it's automatic at 78. And then there's the final part of the rule. This is the ultimate safety net. Let's say you've got a standard 30-year mortgage. It doesn't matter what your loan-to-value is at this point. Once you hit the 15-year mark, that's the halfway point, your lender is legally required to terminate your PMI. The only catch? You have to be current on your payments. The bottom line is, this fee cannot last forever. Okay, so of course, like with any law, there's a little bit of fine print, right? The rules of the road. So let's quickly go over the key requirements to see if this law, the HPTA, actually applies to your specific loan. All right, first things first, and this is a big one. The HPA only applies to conventional loans. If you have a government-backed loan, we're talking FHA, VA, or USDA, those have their own separate rules for mortgage insurance, so this won't apply. And for any of these HPA rules to work for you, you absolutely have to have a good payment history and be current on your loan. This part is critical. You can't be behind on payments. The law also makes sure your lender has to keep you in the loop. They aren't allowed to keep this a secret. They have to give you a disclosure at closing that explains all your rights. Then, they have to send you a reminder every single year. And finally, they have to officially notify you when your PMI has been terminated. You can even remember this with CAA, closing, annual, and finally, a notice of cancellation. Whew, okay, so we've covered a lot of ground here, right? We've gone from what PMI even is to the law that helps you get rid of it. But if you walk away remembering just one thing from all this, please make it this next part. This right here, this is the key. Just burn this phrase into your memory. At 80, you ask. At 78, it's automatic. And at the halfway mark, it's gone. That's it. That's your entire roadmap to saving money.
It tells you exactly when you need to be proactive, and it gives you that peace of mind knowing that even if you forget, there are automatic protections in place to help you out.
So I'm going to leave you with a question. Do you know what your current loan-to-value ratio is? Because if you have PMI on a conventional loan, it might be time to pull out that mortgage statement, do a little math, and see just how close you are to giving yourself a raise.